Over the last week, we saw that Airbnb and Doordash had their IPO. And what I found really interesting about those IPOs is that neither company turned a profit this year. At around March, April, Airbnb really started to struggle as tourism slowed down because of certain world events. And yes, Doordash, even though it's growing at a very rapid pace, and this year they made 3 times as much revenue this year compared to last year, they actually didn't turn a profit this year either. Instead, they lost around $100 million. So my question today is, how could both these companies, who aren't really profitable, come into the stock market and have such high valuations? Not only that, since the start of the IPO, the prices of the stocks for both of these companies have gone up tremendously. So I got super curious, especially because this isn't the first time I've seen a tech company come into the stock market without actually being profitable. So I went digging. This video is going to be about what I found. We're going to start with some of the motivations for why these companies may go public, why this is a good time for them to go public, what makes these companies confident that going public won't actually hurt the valuation of these companies, and some of the concerns that exist with going public in this fashion. So first, let's talk about Airbnb. Airbnb IPO'd on December 10th. And if you're not sure what IPO means, it means an initial public offering. Basically, what this means is before this date, you couldn't really buy Airbnb stocks on the market, but after this date, Airbnb is offering a portion of the company through stocks to the general population. Airbnb had announced that they would be doing an IPO. Initially, they set their prices at $68 a share, but recently that got moved up to $146 a share with a valuation of $68 billion. Remember, for a company that's still not profitable. Doordash also went public on December 9th at a starting price of about $75 to $85, and they provided 33 million shares, bringing their valuation up to a whopping $32 billion. Again, another company that's not profitable but is more valuable than many of the big, trusted, long-term brands that exist in the world. These companies aren't even profitable yet, and they're already valued higher than some national economies in the world. A company that isn't profitable is valued more than a country. So why do these companies go public at this time? Well, there's a couple of different reasons, and some of the main ones are that they are looking for investment capital to expand their operations. They're trying to pay off company debt, so they sell some capital from the company to pay that off. They might be trying to acquire competing or complementary technologies that might grow their business even more. It brings them more money for further research and development to make their products better. Think about Lyft, for example. It's not the most profitable country in the world, but they're working on self-driving tech. And same with Uber. They're both working on self-driving tech. And if self-driving takes off in the next 5 years, let's say, then that would bring down the cost of their operations significantly. They wouldn't need drivers anymore to run Uber or Lyft cars. So these companies are thinking long-term when they are selling these stocks. And another main reason they might be selling off some of these stocks is that initial investors want to at least reap the benefits of some of their early investments. So in an early stage venture, put in $500,000 or $1 million, let's say into Airbnb a couple of years ago, thinking of it as a high risk venture, they might sell off 5% or 10% of their stake in the company to make that money back or maybe make a bit of a profit. So why are these companies choosing to IPO now or over the last couple of years? There's been a shift in how investors actually view the market, especially when it comes to technologies. Historically, when it came to investments in traditional companies, investors would look at how profitable the company was, what their expenses were, what their debts were, how much money were they making, and overall, at the end of the year, was the company essentially making more money than they were spending? And if they were making more money based on that gap, they would value the company more or less. Now, this is a vast oversimplification of the sentiment, but it gives us a big picture idea of what was going on a couple of decades ago. But more recently, something's changed. Investors have come to understand that a company's growth is more important than their current profitability. So what does this mean? Let's say you're a company that's selling a product and you're selling it within one country right now. Well, if you're selling that product in 10 countries, you have the potential to make a lot more money than if you're selling in just one. If you can also sell a complementary product, then you can sell twice as much in the same population. But what do both of these things require? Investment into research and development for new products and investing into expansion for your company in different markets. Both of these things require cash, and they require a lot of cash very quickly to get into these markets very quickly. You can be a US company and you can choose to get into the European market a decade from now, but by then Europe might have their own competitor to your products that work better for the European economy. So you want that first mover's advantage, and to get that first mover's advantage, you need to be fast, and to be fast, these companies need capital. They need money to be able to expand into these markets. So investors have gone from valuing profitability to valuing growth. Is this company growing? So in this case, it's not even in the best interest of the country to cheap out on their research and development, to cheap out on expanding out their operations in the hopes of making a profit early on, especially when a company is only 5-10 years old. these companies are in it for the long haul and they expect to be around 30, 50, 100 years from now. Everyone wants to be the next Coca-Cola. So investors are essentially betting that in the future, this company is going to make significantly more money than they would if they were trying to be profitable today. And that's what keeps this investment engine going. Another reason why it's a good time to actually get into the market right now is that due to certain events this year, there's been a lot of money injected into the market, given to people's hands, and many of them decided that it's a good time to get into the stock market. Stock prices this year have gone from historical lows to historical heights, and everyone is trying to get a piece of this stock market volatility pie. It also doesn't help that interest rates have been lowered to extreme lows. People are able to get loans on the cheap, and they use this money to invest. So more people have more money, and that translates to more people willing to pay money to get into the stock market with the hopes of a big payday. And this is something that companies can take advantage of. In other times they may face greater scrutiny when actually coming into the market. And now individuals are willing to put their money on brands that they trust without necessarily understanding what exactly the value of these companies are today. So this means that you can kind of overvalue your company slightly and you can get away with it. And investors have a lot of confidence that tech companies are actually going to be able to succeed even with all of this going on. And this is something that I think of as the Amazon effect. Amazon has been around for a bit over 20 years now, and initially they sold their shares at around $1 per share, right around the dot-com bubble. That same company is sitting at around $100 per share now. In 20 years, the stock jumped over 3,000 times. If you look at the S&P 500 in the same period, its value jumped maybe 1/100th of that amount. So suffice it to say, there's a fascination that tech stocks are actually able to grow explosively and beat the market in a very significant way. The Amazon effect makes people more willing to get into these companies today in the hopes that they will actually be significantly more profitable in 5, 10, 15 years. It's a risk investment. If you have a chance of making your money 3,000 times what it is today, if you have a chance of making your money 300 times, 3,000 times what it is today in 20 years, wouldn't you take that risk, especially with a small sum? But here's the thing. So if enough people take a risk with $1,000, $5,000, $10,000, accumulates up to a lot of money for these companies that they can then use to actually expand their operations even more. And if the company expands even further, they'll be valued even higher in the long term. Another thing is novelty in tech. There's always the first mover's advantage. Imagine the valuation of Uber. If you got into Uber early, then there was a strong chance that you are able to make a significant profit today. Many investors are interested in getting into a technology in its early stages before other people have a chance to see the value in it. This means they can get in for cheap and they can make a lot of money in the long run. This is kind of the golden age of technology. Silicon Valley has grown, and other markets are showing that they can also compete with technologies and grow companies to billion-dollar valuations fairly effectively. Look at the number of unicorns that come out year over year. Look at the unicorn startups that are coming out over the last couple of years. Unicorns are startups that are valued at over $1 billion. Every year, a greater and greater percentage of those are actually coming out of non-US markets, which is great to see. Innovation should happen worldwide. And people are realizing that if you're able to support these companies by buying equity into them, you can have very high risk but very high reward type situations where you can bet on 100 companies with small sums of money, and if one of them stick and they grow significantly, then they'll pay for those 100 investments plus some more. So what are some of the concerns with getting into these tech companies early? One of the big concerns that I've come across is that the Amazon formula, where they reinvest all of their money into research and development, works, but it only works for companies that are actually tech related. Amazon is kind of a mix of a tech company and a scalability business, right? So they use technology to scale up businesses and to have greater reach for products. So basically they'll take you selling your product in a local market and they'll be like, hey, we can sell it to a bigger audience. And that's the problem they solve. They solve the problem of scale with technology. They know which customers want which products. They'll show that customer that product on their page, and they'll increase the likelihood of someone buying it, even if they're a couple of thousand kilometers away in a different country. You're able to have much greater reach, and that's how Amazon became successful. Uber solved the connectivity issue with transportation with technology. So they were actually able to make a lot of money through just making it easier for you to get from one place to another without having to deal with the stress and inconvenience of grabbing a cab or taking public transport. If you're a tech company that's solving a problem with technology, then this model might work. But if you're not a tech company and you end up presenting yourself as a tech company, then you can end up crashing and burning. Look at WeWork, for example. It was a real estate company essentially that sold office space masquerading as a tech company. Their business was fundamentally based in real life real estate products, which means that they had a lot of background expenses to maintain those products and very high risk if their product didn't sell. But if you're working in the technology space, then your initial investment into a product might be high. So developing an app, for example, but the continual expense of that product might not be that high. So once you build an app, it costs a lot less to maintain that app than to pay a lease for an office, for example, which is exactly where WeWork failed. And they basically expanded too quickly and didn't account for the actual demand of their market, so they fell. One of the concerns is to ensure that whatever company is IPOing, and it's IPOing like a tech company without being profitable, having high revenue but also high expenses, you have to look at whether these companies are technology based and whether that technology itself is actually solving the problem, or if their profits lie elsewhere and they're just blanketing technology on top of it so that they can be known as a tech company and not a more traditional company. So buying a stock today with the hope that the price will be higher tomorrow is that if a lot of people are willing to do that, then there are a lot of people who are going to be willing to pay a higher price today because they think the price is going to be even higher tomorrow. If you're betting on the price being $60 in 5 years, maybe today you're willing to pay $50 for that stock, where the company might actually be worth $30 a stock, because you want to sell in 5 years and you know that you're going to be making a certain percentage in that time. So what happens is this will drive up the price of these stocks very quickly after IPOing, which is exactly what's happening with DoorDash and Airbnb. The prices that they're currently trading in the market is significantly higher than the IPO price. This is something that we have to account for when we're looking at these tech stocks. Since we're always worried about history repeating itself, this rampant investment into companies that are not profitable is reminiscent of the dot-com bubble that happened when I was basically still a child. But this time it's slightly different. The dot-com bubble saw a lot of companies come out and a lot of companies get investment even when they didn't have a fully formed product yet. They were still in the theoretical stages, and there was a lot of belief that the internet would be very successful. So significantly more investment was poured in without really understanding how the technology would fare. But nowadays, digital technologies are much more accepted and well understood. Investments aren't really coming in before a product is being used in the market, and you're not IPOing a company without actually having a product out. Yes, Airbnb may not be profitable, but they're actually selling a product, and they've been selling that product for the last couple of years. Same with DoorDash, same with Uber, same with Lyft. So these companies, they're showing that yes, there is a market, there's a market demand, and the market demand still hasn't been fulfilled. There's room for expansion, there's room for change. So this means that these stocks are much more likely to stick around for the next little while, and there's some inherent value to the services that these products are able to provide, and that's going to translate to these stocks actually being worth something and not being overvalued to the point that they'll be worth in pennies to the dollar if the economy crashes. So what might happen in the next recession? If you're a company that has a high sales volume, let's say you're reaching a lot of people, you're providing a service to a lot of people, then the recession might not affect you as hard as if you're a company that's starting out a bit more, and if the demand for your product is based a bit more on novelty rather than a need. So Airbnb is trying to make travel accommodations more accessible. And yes, that is the exact segment of the market that took a big hit starting around March, April of this year. But the company has repositioned themselves over the last couple of months, and they've actually been able to get out of that instability and come back with the confidence to actually IPO at a fairly high price. There are some companies that are going to default, especially some of the smaller ones, some of the more recent ones, but the effect of a recession isn't just on the local market. We're working in a global economy, and if demand goes down in one place, that doesn't necessarily mean that demand won't be there somewhere else. A lot of these companies operate at a multinational level. They'll be able to take the hit from one country being in a recession for a couple of years and still be able to continue to do business while that country works through it. Unless there's a global financial meltdown like there was in 2008, then most larger, more established companies should be fine. So are you jumping on the Airbnb and Doordash IPO to get in early before these companies are worth trillions of dollars? You couldn't do that. They are definitely growing, but what I wouldn't expect is big short-term returns. The big short-term return you would have gotten is if you bought it on the day of IPO and you managed to sell it 2 days later. I expect these companies to have their valuations grow slowly as they make more and more revenue, as they're able to expand. But maybe in 5, 10, 15, 20 years, they will be worth a lot of money. But there's also an equal chance that they won't be. I'm not a big fan of short-term investments, so if you want to invest, I would say go for companies you believe in and think long-term. I'm no financial advisor, so this should definitely not be taken as financial advice. Just like Rome wasn't built in a day, neither were these tech companies. That's everything from me today. Remember to subscribe to the channel and like this video. It helps this video reach more people. And remember to always keep learning. Bye-bye.